Hello, and welcome to the Capital Wire. In this video, we're going to learn everything you need to know about pre-market hours trading and after-market hours trading. After-market hours trading is also commonly referred to as extended hours trading, and it tends to be abbreviated as AHT, with most traditional retail brokerages which permit it. After-market hours is a period of time after the regular stock market closes, when investors and traders can buy and sell securities outside of the regular permitted trading hours between the hours of 9:30 a.m. and 4 p.m. Trading outside regular trading hours has been around for quite some time, and it was typically reserved for high net worth individuals and institutional style investors. The emergence of ECNs has enabled regular retail traders and investors to participate in after hours trading. So how does pre-market and aftermarket trading actually work? There are essentially three primary time windows in which traders and investors can buy and sell securities. The pre-market trades between the hours of 4 a.m. and 9:30 a.m. Regular market trades between 9:30 a.m. and 4 p.m. The after-hours market trades from 4 p.m. to 8 p.m. The pre-market and the after-hours market operate in the same way as regular market in that securities are traded on an agreed-upon price. The price you receive during the pre-market hours and during after-market hours is the price that someone is willing to pay. If you decide to participate in pre-market and after-hours market trading, it's important to be aware of the inherent risks that are associated with it. One of the primary risks associated with pre-market and after-market hours trading is limited liquidity. It's important to note that pre-market and after-hours markets will have reduced liquidity, higher potential for volatility, and thinner volumes than during regular trading hours. This will greatly impact the price a seller ends up receiving for their shares. Another inherent risk in trading during aftermarket hours and pre-market is limited order types. It's important to note that in order to actually get filled on your pre-market and aftermarket orders, most brokers will only accept limit orders and will prohibit you from getting filled on market orders. This is done as a protective measure for traders and investors in order to prevent them from not getting fills that are in line with the actual market. This protective measure can vary from broker to broker, but most will not allow you to get filled on regular market orders during pre-market and aftermarket hours. This way, the potential for slippage is eliminated for clients and price execution risk is greatly reduced. But in that regard, you're only limited to specific order types. Another inherent risk is larger spreads. Less volume tends to equate to larger bid-ask spreads, which can make it harder for investors and traders to get executed on a price they want. Another risk is volatility risk. Less trading volume tends to lead to more price volatility. It can cause prices to vary dramatically in a very short period of time. And lastly, additional trading fees. Another thing to keep in mind is that most of the orders that get matched during pre-market and aftermarket hours are facilitated by ECNs, which may have additional trading fees depending on the many different pricing factors that are involved with after-hours trading. Now, there's many unique reasons why investors choose to trade during pre-market and aftermarket hours, which can have some benefits. For one, it allows investors and traders to exit positions they don't want to hold overnight, or reduce exposure going into certain economic or company news events that they failed to exit before regular trading hours. Also, being able to trade after the regular market closes can allow you to act quickly to breaking news events by companies such as earnings releases or fresh information before the market opens up the next day. Although spreads and volatility increase during aftermarket hours, it provides you with additional time to get into trades that you may have missed during regular trading hours. With all that in mind, let's take a look at the step-by-step process to execute a trade after the regular market closes. So the trading GUI that we're going to use to show you how to submit an aftermarket order or a pre-market order is through Interactive Brokers. So the way we're going to go ahead and submit this order is first select the security, the direction, the quantity you wish to trade, and then the duration of the order itself. So here you have a day order, good till canceled, and then you have these two other options, which allow you to fill the order outside regular trading hours, which is after the market has closed. And the other option, allow pre-open, which if checked allows you to send an order before the regular market has opened. So if we select fill outside regular trading hours, this will allow us to submit an order after the market has closed. But as mentioned previously in the video, the broker that you use will tend to only allow you to place limit orders after the market has closed. due to many different reasons that were discussed in the video. So let's just select fill outside regular trading hours and click submit. After you click submit, you will see this order window, which will allow you to submit the limit order. And after we click transmit, you will see that we have placed the limit order. One thing to note, if the limit price aftermarket never hits the limit price you set, you will simply fail to get executed. If it hits the limit price, you will be executed at that price. And that is how you submit an order for execution after the market is closed. If you guys enjoyed this video, please make sure to hit that subscribe button.